Hi, and welcome to the Macro Show. We talk macro, and you wonder, what will Biden's global minimum tax rate do to your money? More importantly, maybe to your stocks. We're going to take a look at that. We've got the ISM Services PMI to look at, how hedge fund managers are positioned in the futures market, and even the credit data. I know it was out on Friday. I thought it wasn't going to be. Contraction City. We're going to definitely take a look at that. I'm your host, Steven Van Metre. Let's get right into what's going on. So we've got this global minimum tax, and you maybe remember from Friday's show, if you got a chance to watch it, I kind of said it kind of feels like a border adjustment tax. It isn't, and there's a little bits of it that are. So I listened to Janet Yellen speak about this today, which is kind of interesting that the Treasury Secretary is out promoting a tax increase. And this is going to be the largest tax hike, if it's passed, since 1942. So this thing is massive. Now, what's the deal? Why are they trying to do this? Is because what President Biden wants is a global minimum corporate tax rate of 21%. Because what's happening is, you obviously United States has a certain tax rate. Well, in another country, to get us or to get corporations to move their headquarters, we'll say, hey, we'll give you a lower one. And then, someone else lowers, and then there's another one lower. And next thing you know, you're just racing to the bottom. That's the whole idea is, hey, we're racing to the bottom, and this isn't helping any of us. In fact, it's hurting all of us. So why don't we all, when I say all, I mean all the G20 countries, agree to a minimum rate, and then to perhaps incentivize local production of goods and services, you can offer, tax credits for that. Because the idea is you can have a mega factory somewhere and you can really, pump out things to serve multiple markets. I mean, maybe not with everything, but you can get away with that to some degree. So the idea behind this would say, hey, if you want to make cars, for example, rather than having, say, a mega factory down in Mexico somewhere, well, you're going to need to have a factory in the U.S., factory here in Europe, factories all over the place, smaller ones, which will help the local tax base, rather than one giant mega factory in a place with, say, low corporate taxes. Now, what does this mean to your money, right? Okay, so let's take a look at this chart from Financial Times, and it's not good in terms of what it means for your money. It says potential U.S. tax increases, a double blow for Wall Street stocks, expected impact on earnings per share. So look at communication services, right? These are like your big phone companies and stuff like that. A nearly 10% hit on earnings per share projected. Tech companies, 9%. Healthcare, 9%. I mean, so you're looking at some big cuts to earnings per share with materials just under 5%. So what would that mean for stock prices? Well, that would probably be pretty bearish if you're going to take a hit to someone's earning per share. But really what I think is interesting here is what kind of this means from a broader picture. First, let's answer the question is, what are the odds of this passing? Well, probably somewhere near zero, right? I mean, let's face it. The Senate, you've got split 50-50. Republicans are not going to vote for a tax increase. And even if you got some of them too, you'd need 10 Republicans and all 50 Democrats to say, yes, this is a good idea. We're all for it. And the probabilities of that, again, somewhere near zero. So can this thing see the light of day? The answer is yes, just not anytime in the immediate future, because will be another chance later this year to do a budget reconciliation where this could be passed with 50 votes by Democrats, meaning President Biden's got his work cut out for him just to get his own party to go along with this. And then, of course, he's got to get the House majority, which they still have, to go along with this as well. So it is possible. It's just not probable in the immediate term. So I expect there to be lots of back and forth on this. What will be the end result? Will they go the reconciliation route? Will they try to put together a bipartisan deal? I don't know. But what I think of this from a more interesting standpoint is a lot of people think the end game from the monetary system's coming, right? We talk about this on the show. Is everyone thinks, okay, the central banks are going to, screw up. They've already screwed up, but it's just a matter of, okay, this thing isn't going to work, and they're going to have to start printing money. We're going to see inflation. And from there, we're going to go to, for some reason, cryptocurrencies is going to be the answer. Still not sure why that is, but that seems to be, people believe that. Other people say, no, we're going to go back to the gold standard. That's probably not going to happen. And that seems to be the view. What this bill potentially says is, no, the game isn't over on this fiat currency stuff yet, because we're just going to tax you. And then we're going to give it to people, and maybe that will be inflationary. And see, we need to, because we're going to create jobs and we're going to put people to work, and that will create inflation. See, the game isn't over. And this tells me far from it. So keep in mind, more taxes probably coming at some point. All right, let's go on to the economic data. And we have the market composite PMI, services PMI from Market. Remember, Market is a different company than the ISM, Ministry of Supply Management. Market is not considered the gold standard. The ISM is. But to me, the Market is a little more accurate. And what do we see on the services side? Well, it was 59.8. Remember, over 50 is an expansion, so we see a 60.4. So what does this mean? It's a diffusion index that says that the services sector expanded slightly faster than it did in February. That is a good thing. And we would expect that because as the economy is reopening, the services sector was hit the hardest. Bringing the composite, now when you see composite, think of the manufacturing and the services PMIs together to give a broad gauge of the total economy. And what you have is a prior print of 59.5, a March print of 59.7. So what effectively tells you is there's almost no change between the growth between last month and March. But still, a print of 59.7 says the broad economy did expand, and that is good. I guess let me restate that. A 50 would say it was unchanged. There was no change. This just says it expanded at nearly the same rate as it did last month. So we'll clarify that. All right, let's move on to the gold standard, the official, in air quotes, ISM non-manufacturing or with services PMI for March came in hotter than expected at 63.7, saying the services sector, according to the ISM, expanded at an even faster rate than it did in February at 55.3. So 55 was pretty bleh. I mean, it was like more. It was expanding, but at better than just slight. It wasn't great, but a 63, it tells you the services sector is reopening. Now, what was leading this is the non-manufacturing services prices at 74. We're going to look at that. New orders are up. Employment was up. Business activity was up. And so here, let's take a look at the services sector, and let's kind of look at a few of these of interest to me, and let's see what we can find. So from the history of it, you can see it's been in the mid 56 to 58, 55, and boom, now March, big jump. Obviously, we're seeing the economy reopen, services industry get back into business. New orders. 39% of firms reporting more new orders. That's a good sign. So you want to see, in a growing economy, more new orders. How about employment? 22% of firms saying they hired. Higher employment. Supplier deliveries. This is a problem because one of the things I think that's going to happen, and you're seeing this at least in the ports, not perhaps related to directly to the services sector, is supplier deliveries are causing bottlenecks, which is causing people to order more stuff because they don't know when they're going to get it. And I have a hunch at some point, as we've seen in February with the Chicago Fed National Activity Index printing a very, recessionary print, I expect to see that once the stimulus fades off, and then you're going to have all of these firms with too much inventory. And speaking of inventory, 32% of firms reported higher inventory. And I'm kind of wondering, because there's no prices received in the ISM, so we know prices paid. 52% of firms reported higher prices, but we don't know how many of them are actually able to pass all of those through. So maybe inventories are a gauge a little bit. We'll kind of watch this in the coming months to see what we can learn from that. But if you want to look at where inflation comes from, so that's where you go to backlog of orders. Because if a company is really backlogged in orders, they can just raise their prices. And so you see 16.6% of firms had a backlog in orders. So effectively, there's or an increase in backlog of orders. So it's really saying that, look, the backlog is about where it's been. There's not a significant increase here to justify what would perceive to be as massive inflation in the services sector. Now compare that to the manufacturing PMI. This had 43% of firms report, increased their backlog. So what it's saying, the manufacturing sector is massively backlogged. That's probably why all these ships are piled up at ports, can't get the parts they need to complete the equipment to get it out into the supply chain and then out to the end user. So you see inflation from the manufacturing side, not so much from the services side. All right, this is kind of interesting. This is from the recent payroll report. The yearly change in March seasonal factors came out, and there was something at the bottom that said holding the seasonal factors constant from 2020, would have resulted in March job gains of 656,000, right on the Bloomberg median. Now, what happened is some may also discount the March surprise due to the Bureau of Labor Statistics treatment of seasonal factors. Rather than hold the seasonal factors constant during this unusual period, the BLS is continuing to recalculate their seasonal adjustment, hence why I don't trust the BLS survey adjustment model with each new month, leading to a large and atypical change in seasonal adjustment compared to the typical year. Seasonal factors subtracted 407,000 jobs in March 2021 from minus 667,000 in 2020. So that meant that 1 million estimated print, it turned out to perhaps maybe a lot less at 656,000 estimated. Let's move on to see how hedge fund managers are positioned in the futures market. Right, we've got the 10-year note back. Speculators are back short the 10-year, betting on higher interest rates, lower bond prices. We are going to talk about that in a little bit when we get to the credit data. Actually, I got a lot to say on that, as you should expect. The 30-year bond futures, they're backing off their shorts just a little bit. And if we go and look at the commitment of traders report here, what we can see is that leverage funds are backing off their shorts. Now, where you see spreading, it's when they're long and short. So they're backing off those positions. This is a 30-year bond. These dealers are still increasing their shorts. Asset managers are reducing their shorts. How about the ultra bond? We see securities dealers are still very short. Asset managers are backing off their shorts a bit. Hedge funds are backing off their shorts. Even if we go down to the 2-year, we see increases in short positions across the 2-year. No one wants to see the 2-year note go down. How about the 10-year? A little bit of dealers backing off the 10-year shorts a little bit. Asset managers increasing their shorts, offsetting that. And look at this big increase in shorts on the 10-year. They're almost 13,000 contracts. That's huge. So big bets on the 10-year, as we just saw right here on this chart, increasing those short positions. Big on that. How about the Ultra 10? They're backing off their shorts on the Ultra 10. Or hedge funds are, asset managers are increasing their shorts, and dealers are not doing much there. Even the 5-year, you see 5-year, which is not one of the ones that is popular at the auctions. Dealers backing off their shorts. Asset managers and hedge funds massively increasing their shorts, each by almost 93,000 between the two. So lots of short increases there, as the market still keeps betting on higher interest rates. But wait till you see the credit data. Oh, man. Let's get on to West Texas Intermediate. Really unchanged here in the futures market. Oil looks to be, trying to hit a top. Let's look at the chart on crude. Oh, here, we got the chart on the 30-year. So look at this trend line. Looks like a topping pattern. We see potential left shoulder ahead, right shoulder, rejecting at 2.4. Hit there in the overnight, hit there in early trading, rejected at 2.4. Tells you there's likely a move now down to 2.2. It's been this way. They'll pull out some of the short positions. The bigger move on the bond market is this 2.2 down to, say, 1.8, 1.7 to 7.5 on the 30-year. That's what we're more interested in, because if that breaks down, then you're looking at a big run in the bond market. How about crude? Down 4.3% today. And again, no real change in the speculative position, but it cannot get past this, say 62 a barrel at all. All right, let's move on to S&P 500. Increased their net shorts. That probably hurt today. And how about the euro? Remember, the euro futures, this is the biggest position in the, if you're looking for the dollar bullish position, if you look at the trade weighted dollar, this is a huge position. And you want to see the euro go down if you're dollar bullish, and you're seeing speculators back off their euro longs. And what does that mean for the dollar? Well, today it didn't actually mean a whole lot, because the dollar actually went down a bit, but it's hanging right around its 200-day moving average. And the next likely move, if the dollar doesn't hold here, is down to just over 92, and then before it makes an attempt at 94. Let's take a look at gold. And gold futures continue to head down. How about that chart on gold? Well, you can see it's kind of ran right into here, resistance at 1730. And where it's just been rejected between 1730 and 1750, can't get past that. So bounced off of support at 1687. If 1687 is a hard spot, if it gets down here and breaks this, there goes gold, there goes everything else. Moving on to, how about the Nasdaq as we refresh the screen here? Still net short on the Nasdaq. That didn't play out well. Russell 2000, they went net short. That didn't play out well for them today. Again, these are as of last Tuesday, so there's a little bit of mystery to where their positions are at the moment. How about the US dollar? No changes on the long position, but the dollar, thanks to the euro declining, is poised to rally. The market is not prepared for that. How about the volatility index? They're backing off their vol shorts, which kind of makes sense a little bit. If you're going to short, if you're going to be shorting something, move to a net short position, you probably don't want to be too net short volatility, because that doesn't make any sense. If the market goes down, volatility goes up. You don't want to be very short volatility. All right, let's take a look at the H.8. Some very interesting things going on here. So let's start with bank credit. I'm not going to go through the PowerPoints. We'll pick those up next week, but I do have a slide that we'll take a look at. Bank credit contracted by $15 billion. Securities in bank credit was up $8 billion. Mortgage-backed securities up $14 billion. And remember those treasuries that nobody wanted to buy? The banks bought $17 billion of them, I believe, now at their highest holding of U.S. Treasury securities at $1.258 trillion. How about loans and leases of all commercial banks? Ouch, down $34 billion. There's some credit contraction going on. Real estate was up a mere $2 billion, with residential up $3 billion and commercial down $1 billion. How about consumers? Remember, everyone's bold up about consumer spending. Well, consumer credit contracted by $2 billion, with credit cards down $1 billion. And the biggest thing that dropped on the bank's balance sheet was cash, fell $157 billion. Woof. All right, now let's take a look at loans and leases and bank credit. Rather than go through the normal charts, we'll look at this one. And what you can see over here on the far right is, well, I can't see it either. We'll have to zoom in, is contraction at, if I can get the mouse to hold, there it is, minus 2.35%. So we have now entered a credit contraction. Now remember, my friends, credit contraction is something important to understand, because it puts downward pressure on the money supply. Because how is money created? Well, when it gets lent in, when people borrow money. Well, what destroys it? Well, when you have a credit contraction. So we're seeing this now. Now, what does this mean for interest rates? Well, let's find out. Let's go back to this chart, and we're just going to go and we're going to overlay 30-year Treasury yields just for fun. And so if you've never seen how this is done, just go there, add a series, and then you can adjust it to the way you want. And then you go over to the format, move it to the right, turn off tooltips, so that way you can see it without my mouse going over a lot of things. And we'll zoom out and make it real big and find out. So what happens to interest rates during credit contractions? Well, let's see if we've got one way over here or not. No. Okay, so here we have 1992. We see a credit contraction. Here's 30-year yields in red. Oh, they went down. Would make sense, right? Okay, let me explain this. People get interest rates or treasury yields wrong all the time. They'll send me an email or call me and say, well, it's got to do to the treasury auctions. Nope. Foreign purchases. Nope. If we draw enough trend lines, right, we get our crayons out, draw enough lines on it, that will determine where rates are. I don't know. There's one thing that really matters more than anything. It's a supply and demand issue. If nobody wants to borrow at a given rate, does it tell you it's too high or too low? Oh, it would tell you it's too high, right? It's that simple. Think of it this way. Let's say you're a bank, right? You start a bank and you have some money you want to lend out. So you put a sign out, I got 6% money. I will lend all the money I got out at 6%. And you get no customers, right? So you're confused. You don't know what to do because you keep hearing rates are going up. So you call a consultant. We'll just say the consultant's a hedge fund manager who's shorting the bond market. The hedge fund manager comes in and says, oh, here's the problem, Steve. You got rates at 6. They're going to 8, man. You need to charge more. So he raised the thing to 8 and nobody shows up. So that doesn't make sense. So you go, this higher thing doesn't make sense. So I'm going to lower my ask to say 4. And next thing you know, people start lining up the door. That's what determines rates in the bigger picture. You can short them higher. The market can short them up, but if there's no demand for people to borrow at that, which this chart tells you exactly that. When it's contracting, it tells you, hey, there's so much demand for credit that people are paying their loans off and not borrowing. Now, what does that tell you from a bank's perspective? Do banks like it when people pay off their loans? Well, they like it when they make their payments on their loan. Now, think about this. Where do banks make a lot of money? When they lend, right? I mean, anybody who's gotten a loan knows you get charged for a doc fee, right? Hey, I got to pay for your printer to print out some papers for me to sign. I mean, every little nickel and dime fee, I'm surprised they don't charge you to use their pen, right? I mean, seems ridiculous, but there's a mountain of fees in these things. Well, that's where banks are making their money. Not so much on the interest that much anymore, they a little bit. So what happens when credit's contracting? People don't want to borrow. They're telling the banks rates are too high. And as a result, what is banks going to do? Make less money. So how do banks fix the problem? Oh, how about you go to the H.8 report and you notice they're suddenly starting to buy a whole bunch of Treasury securities again. Is it the SLR rule? Maybe it's the fact that people aren't wanting to borrow. And so what happens when you get these credit contractions, sure, you can have the market force rates up, and you can see higher rates right here in the great financial crisis led to rates going to new all-time lows. And what do you see right now? Hey, market can handle the higher interest rates, right? These are too low. 2.4% on a 30-year bond needs to be like 3 or 5 or 6%. Look, it doesn't work that way. Because think about this. If you're going to go buy a house right now or refinance your house and mortgage rates for 7%, are you going to do it? No. Well, guess what? It tells you rates are too high. And so what are we hearing from the market, right? Mortgage applications down 25.5% from the recent peak. It isn't telling you that rates are too low. Maybe the market thinks there's going to be a flood of demand, in the months to come. But as of right now, the credit data is telling you no demand, or insufficient demand, and that's going to lead to lower interest rates, because how do you spur credit growth? Not by higher interest rates, you spur it by lower interest rates. So when there is a dollar shortage, you need lower interest rates. When there is excess dollars in the system, then you can get away with higher rates. But as of right now, we do know for a fact we're stuck in a liquidity trap, lower yields, it's what's to come. I'm your host, Steven Van Metre. As always, I appreciate you being fans. Be sure to do the thumb thing and the subscribe thing, and I got a cool special video for you tomorrow. Wish I could take credit for creating it, but I didn't. But I know you will absolutely enjoy it. So about a minute long, so you can't miss it. Anyways, I'm Steve Van Metre. I won't see you tomorrow, but we'll be back on Wednesday for the macro show for sure. Thanks for being fans. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. It is not to be construed as recognition or solicitation by or selling security, financial instrument, or to participate in particular trading strategies. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in the video do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.